Hey everyone, and welcome back to Inside the Portfolios with Hobart Wealth. I'm Jacob Woodrum, lead investment strategist, where I oversee design and manage the portfolios that we use for our clients. Now, what we try to do in this series is give you really a look under the hood, not just at what we own, but why we own it, and really how it fits into your overall portfolio. So today we're going to talk about one specific strategy we use in our prime conservative and our prime moderate portfolios to really help manage market ups and downs. And if any of us have been paying attention to the environment right now, we're dealing with a few ups and downs, but while still trying to keep us invested. Because I think at the end of the day, one of the biggest challenges in investing, it's not just what we own, but it's staying invested when markets get uncomfortable. So to help really walk us through this today, I'm joined by Luke Poggi, who works closely with this strategy. Luke, really appreciate you taking the time to be here with us today.
Thanks, Jacob. I'm very happy to be here.
So let's start out really simple. I want to keep it kind of starting simple. When people hear terms like buffered ETF or defined outcome, it can sound pretty complicated quickly. But if you had to explain it just in the simplest way possible, what is a basic 12-month buffer strategy?
Yeah, in essence, it's going to give us and our investors exposure to a reference asset. Most commonly, that's going to be an equity index, and you get to participate in the returns of that reference asset positively up to some predetermined capped out level. Now, the reason for the capped upside is because also over that 12-month window of time, there is a defined amount of loss protection, right? So you have a buffer on losses, you get participation on gains, but your participation is up to a predetermined and clearly communicated upper limit.
No, that's helpful. So I think just to maybe put that into kind of plain English, you're basically kind of giving up some of the upside if the market goes up in exchange for some protection if the markets go down over typically a set period of time. Is that kind of a fair way to think about it?
Correct. Or I'd go further and say, to anybody that's uninitiated on what a buffer strategy is, it's like an insurance policy on an equity position. But the unique wrinkle is that rather than paying a premium for my insurance like I do with my car or my house or my life, I'm paying for my protection with future potential gains. So, what's cool about this is, hypothetically, let's say I'm in a 12-month buffer strategy. I have 10% protection on losses down. And for that protection, my upper limit is stopped. It's capped at 15%. Well, let's say, a year from now, if the market only happens to be up 9%, we get to participate 1-for-1 in that strategy. You didn't have to pay for your protection, so to speak. If the market grossly exceeds that upper capped limit, the best I can do is that cap, but we got to come into this investment with those clear expectations. And I would wager a guess that, if that's the worst case scenario for a buffer strategy, that's a very good case scenario for the rest of the client's portfolio.
Right. No, that's helpful. And I kind of like the way you framed it initially, and maybe just to pull on that thread a little bit further, if I'm thinking about trying to explain this to, a friend or a family member, what's kind of the easiest way to describe that trade-off? And I think you kind of touched on it already, but.
Yeah, it's putting guardrails on an investment. We, not just us, I'm preaching to the choir. You guys are financial advisors and not just wearing your investment hats, but your psychology hats half the time. We talk about behavioral economics quite a bit, and that, not just regular mom and pop investors, but even financial minds, we put more value on a loss, on a negative number, than we do on an equivalent positive number. I feel down 10% more personally then I feel up 10%. And that's something kind of deep in the recesses of my brain, whether I can rationalize it after the fact, but it's because losing something that was already mine feels worse than potentially gaining something that wasn't feels good. And to say, look, in a single investment here, we can hedge our uncertainty on what the market may or may not do, but we get to bake in protection in the scenarios that we really don't like, and we get fair and reasonable participation that's predetermined in the favorable scenarios. It's like offense and defense in the same trade.
I like that. Yeah, I like the way you broke that down. Transitioning a little bit, I think because I do think this is where this can get a little bit more interesting, and honestly, where I think some people can get a little confused, but most of these strategies are built around one 12-month period. But
Yeah,
but what we utilize, this one is actually doing that multiple times at once
correct.
is a good way to put it. So can you kind of maybe walk us through how that works?
Yeah, to own what I would call, a point to point calendar hedge. I
Mm,
hypothetically, I get exposure to the S&P 500 from January to January, clean
right.
12-month window. There are, I could call it timing risk, you could call it luck
Hmm.
to what
Hmm.
my experience winds up being. Let's say I get that positive performance for the first 11 months. And then, something happens in the world, there's some news event, and the market gives back some of those gains. I trade along, I have to pull back a little bit from that high. But I didn't get the buffer protection because the buffer starts at my beginning, my day one
Right.
level of my investment, right? So we would call that kind of an unlucky trade.
Mm.
Whereas a buffer that reset its protection just 1 month earlier, let's say from December to December, uh, gets to participate up in those gains and then happens to reset its buffer at the higher level. Two identical calendar hedges just run over different periods of time can have variance in their performance. So for people who are implementing this buffered strategy really as a strategic position and they want to have exposure to that asymmetric downside protection but upside participation, we strongly recommend to diversify that risk away and own multiple structures. So
Mm.
we're not here to say that one is better than the other. We have
Right.
plenty of clients that do one or the other. But that's a conversation for any individual investor with their advisor. But we have generally found that our power users of buffer strategies who have really gotten to see the value of what they can add to a diversified portfolio like spreading their risk across a lot of
Mm.
these points in time. And I'll give you kind of one other key example is let's say if we are buying a buffer strategy, the main thing that we're buying is protection. And let's
Hmm.
say, we bought our buffer strategy and the market continues melting up as we've kind of seen over the last few years. An analogy I like to make is think of a rock climber making their way up, a cliff face. Unless you're the guy who does it without the ropes, who's a
Right.
maniac. But if you wait, what rock climbers do is they work their way higher and higher, and they reset their line and their protection as they go. We
Mm.
like the fact that instead of saying, all right, for my buffer investment, I get new protection. I reset my protection on all of my investment once a year as opposed to I'm getting new protection at higher and higher levels on a portion of my investment every month, right? So
Mm.
as we climb, we get to slot on buffers at higher and higher NAVs on whatever our underlying asset is. And, we don't have the crystal ball. We don't know when the market rolls over, but we will have banked in fresh protection at the highs more systematically when we own a portfolio of these buffer structures
Mm.
as opposed to just one.
No, I love that. I love that analogy too, the rock
Yeah,
climber. It's a great way to think about it and to kind of put it into perspective. But I think I hear what you're saying, which is, instead of putting all of our money into one starting point, we're just looking to spread it across different starting points throughout the year. And so, we're not relying necessarily on trying to just time things exactly right.
correct. I mean, laddering, think about, there are a lot of bond funds that ladder out their exposure across different maturities. I mean, the concept is here. We don't want to own exclusively, the one point-to-point structure. If we plan on doing it over an extended period of time, we get the benefit of, again, I'll belabor the point, we get the benefit of
Hmm.
diversification and we get the benefit of resetting protection in our growth environments. We also get the benefit of resetting additional protection in drawdown environments as
Right.
well.
Well, none of us want to be the rock climber without the protection built in, right? So without the
That guy's
safety
a
net.
beast. Yeah. Oh, yeah.
Yeah. One thing that I think is really, it's important to talk about because we tend to get this question a lot, but it's specifically around, I think, the misunderstanding that some people uh, get around, a strategy like this. And I don't know if maybe you can speak to a couple of the things that you hear time and time again around maybe the misunderstanding of the strategy itself.
Yeah, that it's not a silver bullet.
Mm,
Buffers aren't meant to be exclusively your entire asset allocation program, as much as
right.
my shop would love that. But it is meant to play alongside sort of a traditional or modern portfolio theorist's, bridge to constructing a diversified portfolio. I mean, we
Right.
really
Right.
want to advocate for the primary and very precise investment objective of buffers is the protection. Historically
Mm,
seen, the way that I think a lot of investors for a long time have managed the equity risk in their portfolio is either by, avoiding the risk altogether, let's say putting it in cash. And now the onus is on the investor with respect to redeploying that capital and the timing with which they do it.
mm,
Or it's division and it's allocating to uncorrelated assets like stocks and fixed income and alternatives. And I'm a big fan of modern portfolio. We are as well. But I think the grand assumption about that diversification working for the client is that it's something that works over time. Uncorrelated assets do work together over full market cycles. And I come back to the behavioral utility of buffers, which is in real time when our clients maybe are at risk of making a poor decision at the wrong time, when markets do get a little choppy or uncomfortable, we have seen plenty of instances historically where a lot of those diversifying assets actually go positively correlated to one another. And you think you're diversifying assets, are not actually helping you in those acute moments. Buffers have a very clearly defined role,
mm.
and that's downside protection. And we're able to still give people a fair amount of participation up as a byproduct of it, which allows for kind of the guesswork of when do I deploy it to be taken off of their hands. But I've heard some criticism of buffers, that whether they are, they're positioned as some sort of catch-all, or, they're not. Buffers aren't going to
Right.
outperform pure equities over the long run, and they're not designed to. They have a very
Hmm.
specific job, and it is delivering on something that we think our clients care about, whether they admit it or not, which is not losing as much during the uncomfortable periods. They do that job really consistently and really well.
Yeah, and I would, we do see that quite a bit. I think sometimes people think that they're getting more protection possibly than they actually are, or that they're going to fully keep up with the market, on the
Yeah,
upside.
yeah,
But
that's
to
yeah.
your point, really, it's about the smoothing the experience. We're not eliminating risk, really, or maximizing returns, but let's just try to smooth out the ride.
That's exactly right. I mean, I tell everybody, take a look and see how these play alongside what you already own.
Hmm.
And, I mean, speaking at least, I work with a lot of financial professionals, but I'm not being hyperbolic when I say this. I have not had very many, if any, uncomfortable or unhappy conversations about the job buffers do.
Hmm.
They're kind of vanilla and straightforward by design. Um,
Right.
I'm parroting our CEO who told me when I first joined the firm, we're in this unique position in that we're not really delivering in kind of the traditional sense performance so much as we are delivering a utility. And that
Mhm.
utility is precision with respect to a very evergreen investment objective, which is how do I mitigate the size of my drawdown?
Yeah, that's really a key point. And I think from our perspective too, that's how we tend to use it and why we use it in our portfolios. It's
Yeah,
not really meant to it's not a replacement for stocks. It's not
correct.
meant to really act as, exactly like bonds either. I think it sits, for us somewhere in between. It's a way
Yeah.
for us to stay invested in the market, but try to make the ride a little bit smoother along the way is really the idea.
To your point about it sitting somewhere in between, we're fortunate enough to have been at the forefront of this new investment category.
Mm.
Yeah, our Morningstar category didn't exist 4 years ago. I mean, like, the labeling of what buffers are and how do I think about them, where they slot in, sort of took some time for the industry to catch up and say they're kind of their own thing, but they're very complementary to the traditional labels that we apply, in classic portfolios,
Yeah.
equities, bonds, alternatives, target outcome and buffers really kind of live in their own space and are complementary to all.
Yeah. We've touched on this, and I think so. I don't want to belabor it, but maybe just two other kind of follow-up questions to what we were
Sure.
just talking about is, one, where do you tend to see this type of strategy working best? And maybe just as important,
Phew.
when might it not work, the way someone expects? And you've touched on it a little bit already, but let's maybe just pull on that thread a little bit longer.
Yeah. Well, again, when might it not work as someone expects? I think really just comes down to how well do we, I mean, you, the advisor, us, your partner and asset manager, set the appropriate expectations. I think that if the expectations are couched appropriately, there's very little surprise with
Mm.
what somebody experiences in a buffer, and that's kind of the beautiful thing about it. We know what our underlying reference asset is. We know what our parameters are going to be for a forward-looking 1 year window. We can say with confidence, with predictability, if the market does X, a buffer strategy delivers Y because we're getting the precise terms of a forward priced option contract, right?
Mhm.
But um, where I think we see these used effectively, it's going to sound like I am, dodging the question when I say, I mean, I've seen them used so many different ways at this point. But I'll give a little bit of context. When buffers first came onto the market, it was 2019, and COVID notwithstanding, in 2020, we were in a very low interest rate environment in 19, 20, and 21.
Right.
And the market was kind of chugging along with little to no volatility. So, you've got your protection, and in an environment where vol is low and interest rates are low, maybe your upside cap isn't, that attractive. Well, if equities are just blowing past it, that could be an area or a time where buffer strategies underwhelm. But then lo and behold, 2022 rolls around, the market does sell off. Bonds aren't really the clean yin to equities yang as maybe some people thought. Both of those assets sell off together, and people who had been in buffer strategies getting the defined loss protection got to benefit meaningfully out of it. But
Mhm.
again, thinking of these use cases in the pre 2022 interest rate environment, we saw a lot of investors using buffers as a supplement to the fixed income side of the portfolio, which was, markets are doing great, bonds are our diversifier, but man, there's just not a lot of return to be had on the fixed income side. I can get a little bit more return from a buffer relative to bonds, but I'm not taking on pure full equity risk. So again, it kind of lives between the two. Fast forward to a new interest rate regime, and I think buffers are being used as they were probably initially intended, which is low vol equity. Let us
Right.
complement the equity side of the portfolio and get you a very effective, a very malleable risk management tool. But looking at the price return of a buffer strategy over time, directionally correlated with equities, but with a fraction of, the volatility ride, smoothing of the ride, as you said before.
Right.
So
No, I
again,
think
it's
that's
it's
a
a bit of it's a little bit of like every column. We've seen these used in different ways, but I sort of say it's now more than ever, I think we have endeared ourselves to the asset management, the wealth management space as collaborative partners, there are a lot of buffer strategies that are available in the market now, and there have been a lot that have been launched over the last few years. I get to wear really a more consultative hat than I ever have, and kind of ask you all the questions of what's your starting portfolio look like? What's the expected return and risk of your portfolio without buffers? And then when we incorporate buffers in, is there a goal in mind? Are you trying to maintain a consistency from a risk standpoint and maybe improve returns? Maybe you're comfortable with the return expectations. You want to bring risk down. Maybe it's a combination of both, but there's a lot of ways that you can go because of, the flexible but yet consistent profile that buffers tend to provide. It really allows for sort of a choose your own adventure kind of a way, but we often get that question and we respond to it with the question of what's your goal? What's your investment objective right now? And let's steer it that way and try and match the right product with the right objective.
I think that's a really important point. And, to your point, no strategy is going to solve everything.
Exactly.
This is just one tool that we use to try to improve the overall experience. And to your point earlier, this is why for our clients, we've built it within, our conservative and our moderate strategies, just because we've found that it really complements, what we're doing.
Yeah.
Yep, from an equity standpoint to still get hopefully competitive return over time.
Yep.
But not take all the downside as well. So So thank you.
Yeah.
Luke, really appreciate you taking the time to walk through that with us. I think that was incredibly helpful. And hopefully for those of you watching, this gives you a better sense of not just what this strategy is, but frankly, how and why we actually use it inside portfolios. Because at the end of the day, this isn't about finding one perfect investment. It's about really putting together the right mix of tools to help us stay invested, navigate different market environments over time. And this is just one example of how we're trying to do that in a thoughtful and a disciplined way. As always, if you have any questions about how this fits into your specific portfolio, we're always happy to walk through that with you. Thank you again for joining us, and we'll see you next time.